This is John AG checking in. Today, gold didn't just move, it exploded. Prices jumped over $300 in a single trading session, marking the biggest one-day dollar surge we've seen since the financial chaos of 2008. In practical terms, that's about a $2 trillion shift in value in just hours, roughly equivalent to the entire market value of Amazon moving in one day. No earnings calls, no CEOs, no corporate announcements, just the oldest store of wealth on the planet reminding everyone that it still matters. Gold climbed nearly 6% in a single session, while silver shot up roughly 14%. And when gold, silver, and copper all surge together, that's usually not speculative hype. That's markets reassessing what real money is supposed to be. Legendary trader Jesse Livermore once said markets speak long before people understand why. Smart money listens first, asks questions later. But here's the piece most people are missing. Physical silver is becoming incredibly hard to obtain right now. Dealers across major markets are reporting shortages. Refineries are backed up. Several mints have paused production. And many bullion sellers simply have nothing left in stock. One of the major bullion distributors even announced that the physical market is under heavy pressure, particularly for silver. Demand is overwhelming supply, and inventory is drying up fast. They managed to maintain stock only because they prepared ahead of time. But even they warned that pricing premiums will soon reflect real-world scarcity conditions. To help smaller buyers access inventory, they reduced purchase minimums significantly, acknowledging how tight the situation has become. And this is the key point. Access to physical metal matters most when markets start showing stress like this. In yesterday's update, I talked about a potential move toward the high $80 range for silver. At the time, price action suggested that area was an important technical crossroads. We didn't hit it immediately, but today the market finally touched that zone and then quickly pulled back. I won't dive deep into the technical reasoning here. That requires an entire breakdown on its own. But this channel has always focused on preparing for multiple outcomes instead of predicting one. No hype, no emotional trading, just scenarios backed by data so you can plan instead of gamble. And if these breakdowns help you think more clearly about the markets, make sure you're subscribed and drop a comment with OG John AG, so I know the real community is still here. Because this audience isn't just traders chasing quick profits. Around 70% of viewers here are long-term metal holders. People stacking for years, sometimes decades. Others trade shorter-term price swings. That's why we cover both sides, the physical reality and the paper market movements. Different strategies, same goal. Make decisions based on planning, not emotion. Right now, as I'm recording this, Western silver spot prices and futures are hovering around the mid-80s, while Shanghai markets are trading significantly higher. That gap represents a strong premium in physical markets overseas, showing real demand pressures. Just a few days ago, I discussed an important technical scenario. If silver fell below a key hourly trend indicator while trading near the $100 level, we could see price drop into the lower 90s or even high 80s region. Initially, the market bounced exactly where expected, but later developments, including Federal Reserve signals, pushed prices even lower. And let me be very clear, those weren't predictions or signals to buy or sell. They were planning scenarios, tools for preparation. And as markets unfolded, those levels played out almost exactly as anticipated. Now the critical technical level everyone should understand is shifting. That same indicator that once acted as support is now sitting much higher, turning into resistance instead. And after such a violent bounce off the lows, many people are already calling this a final bottom. Personally, I don't call tops or bottoms. Nobody consistently can, no matter what they claim online. In fact, watching influencers claim insider knowledge at moments like this is more entertainment than serious analysis. But here's what the data is actually telling us. Trading activity in futures markets has been completely flushed out. Contract participation dropped to levels we haven't seen in months. When this kind of liquidation happens, it usually signals panic selling is nearing exhaustion. Weak hands get shaken out. Leveraged traders get forced to close positions. Markets reset. However, the trend indicator we discussed earlier is now acting as resistance instead of support. Price is still trading well below that critical level. And when markets fail to reclaim former support, it can signal further downside risks remain. So let's calmly walk through both possibilities in the next section. So now let's break down the risk side first, because ignoring downside possibilities is how traders get wiped out. The technical picture right now is sending mixed signals, and one of the biggest warning signs is how former support has flipped into resistance. That hourly trend level we discussed earlier, the one markets respected before, is now sitting well above current price, sloping downward. When support turns into resistance, that's usually a bearish development. It tells us buyers lost control, at least temporarily. Silver attempted to push into that 87 to 90 range, but couldn't hold the move. Sellers stepped back in, and price slid down again. That rejection matters because it shows the market wasn't ready to sustain higher levels yet. If buyers can't regain momentum and push prices back above 90 with strong volume, the market could easily revisit lower support zones. And if broader risk sentiment continues deteriorating, prices could retest previous lows again. And risk sentiment across markets right now isn't exactly healthy. Bitcoin just dropped below the 74,000 level for the first time in months. Major stock indices are pulling back. The S&P slipped, tech stocks weakened, and investor confidence indicators are sliding back toward fear territory. At the same time, global bond yields are surging. Long-term bond rates in Europe, the US, and even Japan are climbing toward multi-year highs. Rising yields signal financial stress, and when stress appears, investors often sell whatever they can to raise cash, even assets they believe in long-term. That includes precious metals, at least initially. Add geopolitical tension to the equation, and volatility spikes even more. Headlines about military escalation or international conflict create uncertainty, and markets typically react by reducing risk exposure across the board before safe haven buying eventually returns. So in the short term, we could still see wild swings before any sustained rally resumes. That's the cautious scenario. Resistance overhead, risk-off sentiment spreading, yields climbing, crypto breaking down. All of these factors suggest volatility may not be over yet. But now let's flip to the other side, because the bullish case is just as compelling. Despite paper market weakness, physical silver remains incredibly hard to find. Dealers are reporting shortages, refineries are overloaded, and inventories across multiple suppliers have been drained. You can't fake empty vaults or delayed production. When physical supply tightens while futures prices remain low, it creates a disconnect that often resolves with higher prices later. Central banks continue adding gold to reserves at a historic pace as well. For nearly 3 years straight, official institutions have been net buyers of gold month after month. That isn't speculative trading, that's long-term monetary positioning. And while retail investors panic over daily price swings, central banks are quietly accumulating. On top of that, futures market participation has collapsed to multi-month lows. When open interest drops sharply, it usually signals forced selling has already occurred. Leveraged traders get liquidated, weak hands exit, and selling pressure eventually dries up. That environment often forms the foundation for a market recovery, though timing is never precise. History also shows that precious metals bull markets are never smooth. During past currency crises, gold and silver regularly experienced brutal corrections before continuing higher. Massive swings are normal in these cycles, even if they feel unbearable in real time. And despite what mainstream financial commentary suggests, long-term demand for precious metals doesn't depend solely on central bank policy decisions or changes in leadership at financial institutions. Demand is driven by debt expansion, currency debasement fears, and people seeking ways to protect purchasing power. Those forces haven't disappeared. China and India alone represent billions of people culturally inclined toward gold ownership as savings, independent of Western financial narratives. Add institutional accumulation to that, and long-term demand remains strong even during corrections. So the situation right now presents a clear tension. Technical charts show caution signals. Physical markets show tight supply. Futures markets show liquidation exhaustion. Central banks keep buying, and price sits right in the middle of that battle. So the real question becomes, have we already seen the bottom, or does the market need one more shakeout before moving higher? We'll dig into that next. So now we arrive at the real crossroads, the point where both bullish and bearish arguments collide, and the next move becomes less about prediction and more about preparation. let's focus on what actually needs to happen for confidence to return. If silver manages to reclaim the 90 level and then push back above that major hourly resistance zone we've been tracking, that would be a strong technical confirmation that buyers are regaining control. It would signal that the recent collapse successfully flushed out weak positions and the market is ready to build momentum again. But if price keeps failing below those resistance levels and starts slipping toward the low 80s or even high 70s again, then we need to accept that the market may want another round of selling before stabilizing. And this uncertainty isn't unusual after such violent moves. Remember, we just experienced one of the biggest single-day gold price jumps in over a decade. Silver surged double digits in hours. These are not normal market conditions. These are stress events. Meanwhile, physical markets continue sending completely different signals compared to paper trading. Silver in Asian markets is still trading at a significant premium compared to Western exchanges. Even after recent price drops, physical metal remains more expensive overseas, meaning actual demand for delivery remains strong. And even after a major correction, refineries are still backed up and mint production hasn't normalized. Supply constraints haven't magically disappeared just because futures prices dropped. At the same time, futures market participation has already been flushed out. Contract volumes have fallen to levels we typically see near exhaustion phases. Historically, that kind of washout tends to happen close to major turning points, though timing remains unpredictable. So we're stuck in this strange environment where physical supply says one thing, technical charts say another, and macroeconomic risks add fuel to volatility. Then add currency movements to the picture. The Chinese yuan has strengthened recently against the dollar, while the dollar itself has shown weakness. When the dollar loses strength, commodities like gold and silver often benefit because they're priced globally in dollars. In other words, pricing power is slowly shifting toward regions accumulating physical metals rather than trading derivatives. And central banks haven't slowed their purchases. For nearly 3 straight years, official institutions have continued adding gold reserves month after month regardless of price fluctuations. That's not speculation. That's long-term positioning. At the same time, respected macro analysts are still raising long-term targets for both gold and silver, even while markets remain chaotic. That's happening while retail traders panic and social media fills with extreme predictions on both sides. So where does that leave us right now? Here's the honest answer. We need more confirmation. The rejection in the high 80s region matters because it shows resistance still exists. But the exhaustion in futures markets and physical scarcity argue that the downside may already be limited. Both sides have valid evidence. This is why disciplined investors plan scenarios instead of making emotional bets. Now here's another crucial point people forget. This price action is being driven heavily by geopolitical tension. And geopolitical headlines can flip market direction overnight. One headline can cause panic selling. Another can trigger safe haven buying hours later. Moves driven by war or political escalation are unpredictable and often reverse quickly. And in environments like this, leverage becomes extremely dangerous. Traders using borrowed money or derivatives often get wiped out during volatility spikes before markets even settle into their real direction. Even physical buyers need to remember that premiums can collapse just as quickly as they rise. Nothing is guaranteed. Not bottoms, not breakouts, not rebounds. And that's why risk management matters more than predictions. So as we head into the final section, we need to talk about what actually matters depending on the type of investor you are. Because long-term metal holders and short-term traders should not be thinking about this market in the same way. So let's bring this all together and talk about what actually matters going forward. Because whether this current zone becomes the bottom or not depends heavily on who you are in this market. If you're a long-term holder, someone accumulating gold or silver as savings over years or decades, then most of this daily volatility is simply noise. Hourly charts, resistance levels, and short-term pullbacks don't change the long-term thesis. For long-term stackers, the real questions are simple. Can you still obtain physical metal when you want it? And are premiums reasonable compared to historical norms? If the answer is yes, then price swings from day to day don't matter much. Over long periods, monetary expansion, currency debasement, and rising industrial demand continue supporting the broader case for precious metals. But if you're trading, especially using leverage, then every price level becomes critical. Short-term traders need to respect resistance zones, understand volatility risk, and know exactly where they'll exit if trades move against them. In markets this unstable, hesitation can destroy accounts. We're dealing with conditions driven partly by geopolitical uncertainty, rising bond yields, currency shifts, and sudden changes in risk appetite. Headlines can reverse price action within hours. What looks like a breakout today can turn into a trap tomorrow, and leverage amplifies every mistake. Even physical buyers need to stay grounded. When markets panic, premiums can spike due to supply shortages, but when conditions normalize, those premiums can fall just as fast. Nothing moves in a straight line, so let's summarize where we stand. First, the technical picture remains mixed. Silver attempted to move into the upper $80 zone but failed to hold it. That rejection shows resistance still exists. Meanwhile, a key trend indicator now sits well above price, acting as resistance instead of support. Until that level is reclaimed, caution remains reasonable. Second, physical market conditions tell a different story. Supply remains tight, refineries are struggling to keep up, and central banks continue accumulating gold reserves at an aggressive pace. Futures markets have already experienced heavy liquidation, suggesting forced selling may be largely finished. Third, volatility across financial markets is elevated everywhere. Crypto markets are under pressure, equities are unstable, bond yields are rising globally, and geopolitical tensions are escalating. These forces create unpredictable price swings across all asset classes. So is the bottom already in, or do we still need another drop before recovery? The honest answer is that nobody knows for certain. What we do know is this: markets eventually reward discipline, preparation, and patience, not emotional reactions. So do your own research. Understand your time horizon. Know your risk tolerance. Don't blindly follow influencers, headlines, or social media hype. Plan for worst-case scenarios. Hope for the best outcomes. But never assume you know what happens next. Trade or invest with logic, not emotion. And remember, in markets like this, survival comes before profits. This is John A.G. signing off. Stay sharp, stay patient, and I'll see you in the next one.